Good morning and welcome to our virtual Masterclass. My name is Elliot Refson and I look after the funds sector at Jersey Finance. Events such as these are one of the cornerstones of what we do. Alongside working with industry and government regarding regulation, legislation and innovation, our mission is to provide clarity on the vital role Jersey plays in international finance. In this session, our expert panel will focus on the real estate sector. As at the 31st of March, assets under administration in Jersey, including real estate, stood at $470 billion. This is a growth of 65% over the past 5 years and just over 100% over the past 10 years. Outside of the fund sector, research by Capital Economics in Jersey's Value to Britain report shows that Jersey is home to more than $780 billion in corporate asset vehicles. Around 4/5 of that is thought to be invested in real estate, with a strong emphasis on the UK commercial sector. In fact, Jersey structures account for around 1/3 by net asset value of the constituent funds quoted on the RFIPD UK Property Fund Index. Before handing over to our panel, if I may just spend a few moments putting our jurisdiction in perspective in order to frame this discussion. Jersey is an award-winning international finance centre whose reputation and regulation is acknowledged by independent assessments from some of the world's leading bodies, including the OECD, the IMF, and the World Bank. This is supported by broad and deep expertise from the nearly 14,000 people, or 44% of the working population, who work in the finance industry. In the fourth quarter of 2019 and the first quarter of 2020, we commissioned a survey to look at the key trends in fund domiciliation. The report found that key issues, including Brexit, BEPS, substance and transparency, have shot up the agenda when it comes to domiciliation and are likely to influence decision-making for some years to come. The report also highlighted increased uncertainty, costs and regulatory requirements in the Caribbean jurisdictions and increased costs and reporting requirements in onshore European jurisdictions. However, the number one takeaway from this report is that investors, and it is the investors who primarily determine domiciliation, want jurisdictions that can offer expertise and political and fiscal stability with a no-change outlook from a regulatory, legal or economic perspective. Having been an early adopter of international substance and transparency initiatives, Jersey has that respectability, it has that stability, and it has that no-change outlook supported by world-class infrastructure, highlighted, for example, by the second fastest broadband in the world. One of the greatest strengths in Jersey is the ability for our government, regulator and industry to come together in a room to engage directly, address issues and to innovate quickly and collaboratively within a robust and globally respected regulatory framework. This approach led to our opt-in, opt-out AIFMD approach, the Jersey private fund product, which can be regulated within 48 hours, our response to substance requirements, which were lauded by the OECD, and more recently, our resilient response to COVID and the changes to our limited partnership laws to make it easier to port LPs from other jurisdictions to Jersey, and in the near future, our LLC laws. One key element of our product offering that sets Jersey apart is our opt-in, opt-out approach to the EU Alternative Investment Fund Managers Directive, AIFMD. Being outside of the EU means Jersey is not subject to AIFMD when targeting investors from the rest of the world. Within the EU, Jersey has excellent, long-standing bilateral relationships with its member states and established market access arrangements via national private placement regimes. These will not be impacted by Brexit. On the other side of the Brexit equation, Jersey's access to the UK is guaranteed under its UK private placement agreement there. To augment this, our regulator recently secured access to the UK in the event EU law no longer applies there, such as in the event of a no-deal Brexit. And in this way, Jersey bridges the gap between the EU and the UK in both the pre- and post-Brexit environment, and takes off the table the uncertainty of what will happen in the UK after the end of the transition period on the 31st of December 2020. But this is only a part of Jersey's flexible marketing proposition. By the EU's own statistics, only 3% of all alternative investment fund managers are registered to market in more than 3 European jurisdictions. And this means that 97% of all managers do not market into more than 3 EU countries. If you are a part of the 3% who market on a pan-European basis or to the retail market, you will most likely need to access EU markets via another jurisdiction under full scope of AIFMD or UCITS. But if you are one of the 97% who do not market so widely within the EU, then Jersey and its European private placement agreements offer a more cost-effective, a faster, and a more efficient solution outside of the full scope of AIFMD. And this is why there are more than 183 Jersey-registered managers opting to market into the EU through the national private placement regimes, a figure that has risen 76% since December 2015. This growth is reflected in the strong support for the national private placement regimes highlighted in KPMG's recent pre-AIFMD2 report. And with ESMA's desire for increased EU substance and reduced delegation of management outside the EU under AIFMD2, we are likely to see an increase in our growing pipeline of managers looking to establish a presence in Jersey. In summary, our key messages are: we have a collaborative triumvirate of industry, government and regulator that leads to innovation and collaboration within a robust and globally respected regulatory framework, always adopting international standards swiftly but pragmatically to maintain our global reputation. We can be complementary to funds in other European jurisdictions by offering parallel structures satisfying a global investor base. We offer future-proofing around Brexit disruption and a marketing bridge to UK and other global investors. We are a stable jurisdiction with a minimal change outlook. And it is for these reasons, reflective of the forecast for continuing growth in alternative investments, that we will continue to grow our global footprint in the years to come as we continue to become the alternative jurisdiction of choice, and nowhere is this more true than in the real estate sector. I am now pleased to introduce Ben Robbins, who is a partner at the law firm Mourant, a former chairman of our industry body, the Jersey Funds Association, and one of Jersey's leading funds lawyers. Ben is also a member of RF's Public Affairs Committee and NRCGT Working Group, as well as a member of the BVCA Channel Island Committee. Ben advises on the formation, operation and financing of real estate funds and investment structures, as well as private equity, venture capital and debt funds. Ben regularly advises fund promoters, managers, investors, directors and service providers across a wide variety of asset classes. Ben.
Elliot, thank you for your introduction, which so clearly evidenced the significant growth in the use of Jersey structures for real estate investment in recent years. So my job today is to explain what is it about Jersey structures that cements that appeal, and to answer the question, why do people choose Jersey structures to hold real estate assets? Well, I think it comes down to 6 key factors. Firstly, the very wide variety of legal vehicles in the Jersey toolkit for structuring real estate funds and holding structures. Secondly, Jersey structures offer a tax neutrality that's more simply derived than onshore structures, without reliance on their complicated double tax treaty arrangements and exemptions. Thirdly, Jersey offers an unrivaled regulatory flexibility, with different regimes to suit the requirements of particular managers and their investors. Fourthly, there's a real experience and strength in depth in Jersey's real estate management and administration industry. Fifth, Jersey has proved itself to be a cooperative partner with the international community, and its transparency, regulatory, financial crime, and economic substance credentials underscore its sustainability as a finance centre. And finally, Jersey is a stable but innovative finance centre that adapts quickly to change, and not least in recent months, absorbing the impact of COVID-19. So let's look at each of those factors in turn. And firstly, the wide variety of Jersey real estate holding structures. Now, Jersey's long been host to open-ended real estate funds for a mixture of institutional and retail investors, for decades, in fact. But more recently, we've seen a distinct move towards more closed-ended funds, largely for institutional and sophisticated investors in the private equity real estate space. And today, there's even more variety in the structures we see, with Jersey feeders and master funds above or below onshore funds, hybrid fund structures that are largely closed-ended but with infrequent liquidity windows, and listed fund vehicles, notably UK REITs established as Jersey companies. We see it all. And in terms of non-fund vehicles, we continue to see widespread use of the now ubiquitous JPUT as a go-to vehicle for holding UK property assets. Such is the familiarity of the JPUT and Jersey company as holding vehicles for UK real estate, there's now a well-trodden path for city lawyers advising UK and international clients buying property indirectly through interests in a Jersey vehicle. And where the structure is leveraged, the acceptance and creation of security over those interests is now regarded as standard by international lenders and their lawyers. And the structuring toolbox available to those creating these structures is overflowing. Apart from the inherently flexible property unit trust, there are several different types of Jersey company available under our Companies Law, which is a shorter, more flexible but familiar version of the UK Companies Act. There are limited companies, guaranteed companies, protected cell companies, and incorporated cell companies. The Jersey LLC option will also follow soon. That will be particularly familiar to US investors, but will also offer cellular optionality. And Jersey limited partnerships can be created in a number of different forms, whether the classic transparent limited partnership under our 94 law, widely used in the private equity real estate space, or the more recently conceived separate limited partnerships, incorporated limited partnerships, and limited liability partnerships. Now, all these different vehicles offer a variety of different tax outcomes depending on whether they're deemed transparent or opaque for a particular tax purpose. And it all makes for a very compelling offering for those structuring real estate transactions for global investors with their diverging needs. And it's very easy and efficient to get funding into and out of each of these structures too. So the second key feature is tax certainty and simplicity. Tax transparency and efficiency is vitally important for most investors, and particularly for tax-exempt investors. And from a UK tax perspective, Jersey structures can be transparent for UK income tax purposes and by election, transparent or exempt for UK CGT purposes under the new rules. Jersey companies established as UK REITs enjoy quasi-transparent treatment for UK tax, and the sale of JPUT units and Jersey company shares is not usually subject to UK stamp duty. In terms of Jersey tax treatment, there's no Jersey income tax or capital gains tax payable by a Jersey fund or its managing trustee or general partner. There's no Jersey withholding tax on distributions to non-Jersey investors. There's no stamp duty on the transfer of units, shares, or partnership interests. And unlike Luxembourg or the UK, there's no VAT in Jersey. And when it comes to the taxation of Jersey fund management companies, where they're to be Jersey tax resident, they're liable to Jersey income tax at a zero rate, but must now meet the OECD's new economic substance requirements, which came into force in 2019. Although there's an additional annual reporting requirement under these substance rules, so long as these companies continue to meet the Jersey management and control norms that have been in play for a number of years now, with Jersey corporate board meetings and strategic decision-making, compliance is straightforward, with experienced Jersey directors and administrators on hand to provide the substance support needed. Aside from that tax simplicity and certainty, Jersey also offers unrivaled regulatory flexibility, its third key advantage. The single asset structures I described above, whether JPUTs, companies or limited partnerships, aren't required to be regulated as funds in Jersey, whereas they are in the EU, the UK and Cayman, where single asset structures held by multiple investors can carry additional regulatory costs in areas such as audit, valuation and custody. Where a structure does have multiple investors, Jersey offers a wide spectrum of fund regulatory environments, from fast-track unregulated funds, if there's no marketing to EU investors, to lightly regulated Jersey private fund structures, through to more highly regulated Jersey expert funds that can target 50 or more investors. Jersey private funds, in particular, have proved to be a huge success since their launch in April 2017. Available for funds with no more than 50 investors, these funds are authorised within 48 hours by the Jersey Financial Services Commission in reliance on an application by the fund's regulated Jersey administrator. And in most cases, the fund's manager will enjoy an exemption from financial services regulation. Well over 350 Jersey private funds have now been launched, accounting for assets under management well in excess of £40 billion. They've allowed new or established managers with a restricted pool of investors to embark on new strategies quickly in a highly cost-effective and efficient manner. In the world of more widely offered funds, targeting more than 50 investors, Jersey's tried and tested expert fund regime continues to thrive, with regulatory licenses issued in weeks rather than months, and even more swiftly for returning managers launching repeat expert funds. And as Elliot has already described, only where Jersey funds are actively marketing to EU investors does Jersey apply its overlay of relevant AFMD requirements, which for larger managers are limited to the directive's reporting and disclosure requirements. This varied regulatory toolkit provides helpful optionality for managers of different types and sizes, depending on the number, location, and type of investors they wish to target. And Jersey private funds in particular are proving more cost-effective than onshore products and offer real speed to market. Jersey's fourth key advantage is the experience and strength in depth of its real estate management and administration industry. And you'll get a very good flavour of that expertise when you hear later from our panellists, Belinda, Zena and Alex a little later. Jersey directors, administrators, auditors and lawyers have been servicing real estate structures for decades through buoyant and challenging markets, including the global financial crisis and the rocky period immediately following the Brexit vote. As the industry looks to navigate the choppy waters flowing from COVID-19, that experience will be invaluable. And the experience spans the full range of real estate asset types, whether office, retail, industrial, logistics, hotels and leisure, residential, infrastructure, including student accommodation, airports, hospitals and assisted living, and whether in London, the UK regions or international. Jersey's fifth advantage is its willingness and ability to cooperate with global authorities in developing international standards. This is an essential feature for a sustainable finance centre in the modern age, as it ensures continued access to global markets. The tax neutrality and regulatory flexibility I've just described is uncontroversial when it's allied with transparency of information that meets global tax reporting standards, effective anti-money laundering protocols, and effective and verified collation of ownership and control information. And Jersey's policy has been to lead from the front in meeting global standards in these areas. It has world-leading FATCA anti-money laundering score and is duly whitelisted in that area. It was a first-wave FATCA and CRS signatory and has a broad network of tax information exchange agreements. The beneficial ownership and control of Jersey companies is captured in a verified central register, and Jersey is now committed to match the EU's fifth anti-money laundering directive in creating corporate public registers by 2023. Jersey was whitelisted by the EU and approved by the OECD in 2019, following the introduction of its substance regime, and the island remains actively engaged with the OECD on its global initiatives, including BEPS. This ability to adapt swiftly to international standards is testament to Jersey's ability to innovate and absorb change, the sixth and final key advantage I wanted to highlight this morning. But it's not just in reacting to international developments that Jersey thrives. Following the successful implementation of the Jersey private fund regime, Jersey LLCs will add yet another product to the Jersey structuring toolkit, and legislation was recently passed to facilitate the migration into Jersey of foreign limited partnerships. Jersey's highly effective reaction to the COVID-19 pandemic has also underscored its reputation as an adaptive jurisdiction. Happily, there's been relatively minor public health impact here, with an efficient airport testing system reducing quarantine and isolation requirements. Working from home across the finance industry was made easy by Jersey's world-leading broadband access, and many are now back in their offices. Statutory e-signing protocols for virtual closings meant that transaction execution has not been impacted, and the close availability of directors has meant wet ink signatures has been quick and easy to obtain where needed. And where external directors were unable to fly to the island for meetings during the March to May lockdown period, the Taxes Office quickly confirmed the relaxation of the usual substance requirement for management companies to have Jersey corporate board meetings. So in conclusion, we recognise that the real estate investment manager community has a wide range of domicile options. Jersey offers a proven, stable, flexible, cost-effective, innovative, and service-driven environment, and sidesteps the tax complexities of onshore models and the future regulatory implications of the UK's imminent departure from the EU. The UK's calming influence on AFMD2 and other European directives will be lost. To many in the global investor market, those relative advantages are singularly important. Thank you. I'm now going to hand over to Mike Byrne, partner at PwC, who will be moderating our panel this morning. Thanks, Mike.
Thank you, Ben. That really sets us up very well for what should be a great panel discussion this morning. Just to finish that introduction, my name is Mike Byrne. I'm a partner based here at PwC Jersey, where I lead our assets and wealth management practice. My clients are a portfolio of global real estate and private equity clients, and I also lead PwC's alternative funds practice across the EMEA region. Could I start by introducing our panel for this morning's discussion? From left, Zina Coupe from LGL. Zina is responsible for LGL Group's client-facing strategy, ensuring the seamless delivery of their client service proposition across a multi-jurisdictional business. With over 22 years' experience in financial services, Zina has held a number of senior roles, most recently as Managing Director of Client Services at SAN Group plc, where she focused on the implementation of processes that significantly increased client growth. In the middle, Alex Lacane from Crestbridge. Alex leads the real estate fund service team for Crestbridge and is responsible for its overall service delivery to a wide variety of client structures, including both open-ended and closed-ended funds. And Belinda Crosby. Belinda is a non-exec director with over 20 years' experience in the Jersey financial services industry, including successfully managing a global brand, highly respected, regulated fund service business for over 10 years. Her experience incorporates all aspects of management, regulation, and compliance for a broad range of Jersey and non-Jersey real estate structures. And Ben, thank you for joining our panel as well. So I wanted panel to start by reflecting on Ben's opening words and ask you as to what you've seen as the biggest change in real estate structuring in Jersey in response to recent changes, and not just the last 6 months, but last few years as well. Belinda, could I start with you?
I'm probably setting the tone here and in some ways not answering the question, but picking up on some of the themes that Ben started with. And that is, I think, continuation of some very good core real estate structures. Their continuing success and growth, and particularly here, as Ben mentioned, the Jersey Property Unit Trust structure, the Jersey Limited Partnership structure. They continue to be key despite numerous changes. Ben's talked about the evolving regulatory regime that Jersey we're seeing both in the UK, nationally, globally. Adaptability of those structures has proved robust. Ben's also referenced very clearly changing tax shifts and emphasis, much more emphasis on that fair play type tax. We've seen it with structures being tested with BEPS, with the general anti-avoidance reporting requirements, specific jurisdiction changes, such and most recently, as again Ben referenced, the UK non-resident capital gains tax. But again, the structures offered by Jersey, the straightforward nature, the fact they're understood and the fact that they're very well supported by the quality of service provision in Jersey, stand the test of time and continue to grow. The final, picking up on a final point, Ben's talked about the implementation recently of the Jersey private fund regime, and that offering where you can pull together for a relatively small number of investors, club-type deals from different jurisdictions, differing tax, has really, really struck a chord, I think, offers the benefits of offering simplicity and speed to market, regulatory regulatory cost efficiency is really doing Jersey well, and we're seeing that use, I think, is just going to continue to grow.
Very good. Zina, what about you? What are you seeing?
Yeah, I mean, having focused on real estate for around 16 years now, it's amazing to see that the JPUT is still one of the most preeminent structures being used by lots of international and global managers. And the flexibility of the JPF being able to take any different type of form, having the ability to list on TICE is really appealing and something that we're seeing as a great strength to Jersey's product offering. I think the way that we've adapted as an island and also as an industry for COVID has strengthened our proposition as well. Still being able to complete the transactions by DocuSign, delivery of documents, speed of efficiency has really been good and highlighted the way we've dealt with COVID as well.
Very good. And Alex, what are you seeing across the picture?
I think just in terms of client trends, I think in more recent times we've seen a trend of people who haven't used Jersey before, possibly using the Caribbean type jurisdictions, moving towards Jersey in this sort of greater trend of focus on regulation and substance. More broadly, I think we see more commonly now the use of multi-jurisdictional structures, so rather than just a Jersey or just a Luxembourg, we quite often see some combinations of those. So I think that's probably the overlay of that.
And Ben touched on COVID, some of the innovations we've brought in. Zena, you've mentioned it. Alex, how's COVID affected your clients across the board? And we'll come to some of the admin points in a minute, but what's the reaction across the industry as far as you've seen?
So look, I think there's some obvious impacts. Most of the clients we work with have established portfolios of assets, and depending on the sector they sit in, you're going to see things like CVAs and lots of things that are creating a lot of asset management work or increased levels of activity. Obviously, problems with rental collection, possibly deteriorating valuations, and then the impacts on debt facilities and things like this. But I think probably the interesting thing is probably the positive angles that people are coming out with. Yep. I think, take debt funds as an example. You've got real estate debt funds who now are talking to our clients, they're seeing a lot more activity and opportunities because traditional lenders are, their appetite's retreated a bit. They're able to step up and their offering is looking a bit more attractive. So there's a lot more activity and potential to do deals, and we're seeing deals actually getting done. More generally, I think the nature of a fund manager is that, you want to be successful, and in this sort of environment, it's big change. Okay. So it's trying to be ahead of the game, spot the opportunities, and we're actually talking to a lot of people that are sort of seeing this and looking to launch funds to take advantage of some of the change and be at the front of the trends.
Well, I'll come back to that, and I do want to understand what's going on at a trend level. But Zena, you mentioned DocuSign, and keen to hear from you and Belinda, and the last 6 months of admin. How's it been? How have we coped? What's your experience been at LGL?
We're fortunate that we don't have a book that's been most affected, so we don't have too much retail, we don't have much hospitality. So we haven't seen the wall of refinancing or restructuring that some people have potentially got exposure on those books have, but we have seen transaction activity in sectors like healthcare, logistics, data centres. We've got a fair bit of foreign money, and they are still doing deals. You did have the big pause where no one could get on a plane, and there were virtual tours of buildings being done, and that's quite difficult for an IC to get comfortable with. So there was quite a pause. In terms of transaction activity, I mean, we were literally all working from home within a couple of days, and we've been able to do a lot by Zoom. I think everyone's done Teams, Zoom, everything, and it's been great because we've now adapted to that, and we're working with that as part of the new regime of how we adapt our business. So board meetings and, the director from the government, that's been great advice. And electronic board packs, speed of getting documents to clients. It's pretty robust, and I think it will totally change the way we all do things going forward transactionally.
And Belinda, non-exec director, big responsibility. What's the last 6 months been like for you in terms of how you've evolved and how board meetings have evolved?
I don't think I could have imagined it if you we'd had this conversation in perhaps November time last year and things. To say that, well, all of your regulated boards, all of your committee meetings, all of your investor communications would all be taking place electronically. I'd be sitting in my study for numerous hours a day. It just wasn't something that was on the picture. That being said, the fact that virtually every service provider I deal with, it has taken it in its stride, and it has happened very, very seamlessly, just, I think, speaks volumes for the robustness of the offering over here. I mean, with all things, whilst there has been major change, Alex mentioned big change going on, at any time of market stress, market crisis, good governance becomes key. It always is key, but it is absolutely vital. And that's what we've been seeing across, sort of what I've been seeing across my range of funds and exposures that I've got to, of clear communication with investments, the boards taking responsibility to look at matters such as liquidity issues, material valuation uncertainty clauses being added and how that impacts being able to price funds for investors, longer term looking at closed-ended investment periods. Do they need to be extended or changed so that you're not going out to the market in times of stress? So all sorts of things coming together at the same time, but the key principles hold true regardless, and that's been great to see.
Okay. Look, as a panel, you guys have got superb view across the industry, right? And I think something our audience will be very keen to draw on, where often they sit in a business with one strategy and maybe a narrow view, is your broad view. So I want that broad view, please, on, lots of discussion around the future of central London office buildings, central London property, retail, etc. Across your portfolios, what are you seeing? Are you seeing big seismic changes, or is the media overplaying this? Zena, what are you seeing? You're doing quite a lot of travel as well. What are you hearing from your clients when you meet?
Yeah, I mean, I think the decision's not there on offices. I think there'll always be a place for good quality assets in the office market. How they're used going forward is the key. And what that looks like, I think, is playing out. There are signs that it will be hit. I think there was a big letting recently that fell apart, that's not going ahead. PRS is holding up well. I think, that there are deals being done in that sector. And certainly there is the move towards people looking to move out, from country living. I think working from anywhere is the new thing, and that will have consequences for offices. I am travelling, I am meeting investors, investors are travelling. I think it's not back to normal, but there certainly seems to be more conversations on deals. Deals are taking longer and some are falling out of bed, and what we're seeing is the mismatch between a buyer and a seller, and a lot of that's to do with rent uncertainty, valuation. So things are taking longer, but we are seeing bid companies set up. But I definitely think there's a lag in terms of timing on deal flow.
And Ben, can I play you in on this? You at Mourant obviously have the benefit of seeing a lot of transactions going through Jersey. What have you seen in the last 6 months? And
I'd largely echo what Zena's just said. Things haven't been moribund. Transactions that were on the cards and about to occur in the sort of period of sort of March, April, May, definitely a slowing down there, a pause. We've certainly noticed in the last month or two that a lot of those deals are now picked up again. So a bit of a normalisation in the market, certainly the UK market in that respect, and whether that's that sort of London or regional. A lot of what we see, as Zena described, is investment by non-UK investors, often in Asia, Middle East, Far East, looking to invest in UK assets. So there's always going to be that element of where are they in the sort of buying cycle. Brexit has caused people to stop and think about what the long-term buying opportunity might be. COVID has probably complicated that.
Yep.
And so has probably concentrated buyers' minds in terms of the particular asset classes. If it's office, what type of office is it? Is it an office that can be now developed to take into consideration the office living changes that COVID is going to demonstrate. At what stage is a particular asset in its development cycle. But we've seen those deals come back to life very much so in the last month or two, which is a positive trend. But Zina's absolutely right. Transactions are just taking longer to complete. And I don't think that's a function of people being working from home or anything like that. I think it's just for boards, for investor committees, as Zina said, just to get themselves comfortable with, well, what is the valuation point now? It's just taking them longer to get there. But it's certainly picked up in the last 2 months or so.
And I want to move on and talk to you about where ESG has been in the last 6 months and, massive trend. What's it been through COVID? What are you seeing for ESG and real estate funds? How big is it on the agenda? And maybe, Belinda, I could start with you as again, a lady who sees a lot of transactions across their desk.
The impact of ESG, the consideration of ESG, both on fund establishment, transaction deal flow, and asset management has been huge. And I would say not just over the last 6 months, but it is a genuine trend that for the last few years that is just going to continue to grow. The impetus is coming from investors. They want to know how the investment houses are considering ESG matters, and not just a mission statement, but they want practical examples on it. And COVID and the impact there, the market stress, yes, it has had an impact, but I don't think that's changed the trend, and it's not going to change the trend. So we're seeing and continuing to see, despite sort of the market pressures, sort of new funds being formed with a whole ethical ESG perspective. I've seen, for example, much more in the UK commercial space on socially supported housing, things to meet the changing demographics. On asset acquisitions, I can't think of the time I've last seen an asset acquisition paper that hasn't had a substantial section with regard to the ESG part on it. And then also, I think for what really excites me for the real estate asset class itself is the practicality when you look at asset management. So ongoing, we're still seeing anything from the really big ticket, energy efficient redevelopment, carbon neutral, offices that have systems inbuilt that monitor energy use and how to improve that, across the board to industrial estates where they're recycling materials from redevelopments from one site to another across portfolios, down to social interaction of public realm on buildings and that. I think as well, picking back up on your question of the impact of COVID and ESG as well, one positive as well we're really seeing across most of the advisors, or I'm seeing across most of the advisors, is a much closer relationship between the advisors, the landlords, the property managers and the tenants. A real collaboration at this time of trying to work together to get the best outcome, rather than a sort of strict enforcement of rent collection, sort of working to see how matters can be resolved and improved.
And I guess that's the S in ESG, societal, make sure it's right. Just to pick up, Ben talked a little bit about structuring. Zina, you've mentioned JPUT, but talk to me for a minute, Zina, Alex, about JPF. Do JPFs work for real estate? Are you seeing them more and more? What have you seen in terms of investor demand? Ben gave a number of 350, I think, JPFs raised. So what structuring options are you seeing, Zina? And Alex, please jump in as well.
You go first. Okay. So we are seeing them being used a lot because, like Ben said, they're so flexible. They can take any form. They can be listed, and they're very easy. They've got great, quick speed to market. They're cost efficient, and they're well understood, not only by the Global Advisory Committee, but foreign and institutional investors. They work well for all types of deals. And again, they can be used in conjunction with parallel structures, which some people have with Luxembourg or the UK. So we are seeing, and I would say that's one of Jersey's probably best assets for the future, and I do see that as one of the preeminent structures that will be used for real estate going forward.
Alex, any other structuring themes you're seeing coming out?
So look, we've touched on the broad range of solutions we've got in Jersey, but recently the Jersey Private Fund is the most common thing we see. It's so flexible that it accommodates so many scenarios. I think it's relatively clear and simple to understand for people who haven't used them before.
Yep.
You can get it to market quickly. I think the flexibility to work with an overlay to market into the EU through the private placement regime is, again, relatively straightforward, but again, accommodates a lot of scenarios. So whilst we do see some other things,
yep,
that is the common structure, and I think it works really well for probably Jersey's sweet spot of, alternatives, PERE managers wanting to, that sort of 5 to 20 investor.
Yep.
It just is spot on for the market, really.
And the vehicle itself, LPs, corporates, variety?
So typically,
yep,
whilst it can be other things, I think at a fund level we see it as a partnership most commonly, or a separate limited partnership. But yeah, we do see some alternatives occasionally, but commonly partnership.
Very good. Very good. We talked about potential impact of COVID on ESG in the last 6 months, but one of the things that's kind of decreased in its prominence has been Brexit, right? It's coming back a little bit, but it definitely hasn't gone away. What's been the impact of Brexit on your client's business? Maybe not just the last 6 months, but generally, and where are you seeing that both as a real estate asset class and more generally? So, Zena, what are you seeing? Is Brexit still a discussion for your real estate clients?
I mean, of course, but, a lot of our clients are big institutions and they've been structuring or trying to structure for Brexit for many years. I think what we are seeing is people really focus on where their real substance offices are, as opposed to having 12 or 13 areas where they had management. They've now focused that down to a lower number. And certainly, Lux has gained from that in terms of people having offices set up, substance offices in Lux. But we still find that they will operate in their key jurisdictions and have regulation in multiple jurisdictions. But I think for all managers, it's still a bit of a waiting game. That their plans are adaptable and they're definitely still being discussed quarterly at meetings on strategy and how they'll adapt their strategies.
Alex, what about you? Many Brexit themes?
Look, I think you referenced that it's decreased in prominence,
yep,
and that's with whatever's going on, and it's probably been around for so long, people have talked about it a lot. So we're not talking about it as commonly, but I think that the themes that come out are people are taking comfort from Jersey's position. Sat outside of the EU, it's marketed in, we've been marketing into the EU from outside for some time. So to a degree, it's little change and we're tried and tested. So I think that gives some comfort, really.
And building on that, those words of substance, I guess another thing that we talked a lot is BEPS, right? And Zena, Alex, you both have the benefit of working across a number of jurisdictions, Jersey, UK, Luxembourg. Talks about the structuring choices and the decisions people are making, whether it's an onshore or a Jersey route. And I guess we present ourselves the whole time as not just a single solution, but as an option within a suite of solutions. So what kind of thought process are your clients going through and what are you seeing in terms of structuring? Alex, I'm going to start with you.
So look, I think it depends on the scenario in question. And I think, probably the most important factor is the investors that are going to see these funds or being targeted. So we do see a mix of Luxembourg, Jersey. I think we touched on earlier that what is increasingly common is this multi-jurisdictional structure. So when with the fund, maybe a feeder fund, the investment vehicles. So I think it's quite important now to have that ability to work across multiple jurisdictions. I think from a UK real estate perspective, it's very common now to have UK vehicles actually owning the assets. And that sort of triangle of Jersey, UK and Lux is important to work together.
Zena, what about you?
Yeah, I mean, I'd echo that. We work on probably identical structures, so we certainly see that. I will come back to the flexibility and the speed of the JPUT and the JPF as opposed to things like, RAFs or, onshore products, which the UK is trying to adapt and will have to adapt for Brexit. But certainly it comes down to what people work with and understand and is tried and tested for them and what their investors can get comfortable with. Some investors prefer onshore for reasons, some prefer Jersey. So very much we're jurisdiction agnostic, but we work with the investors to find the right fit for them.
Yeah, absolutely. Okay, Ben, can I come to you? And I guess you work with investors and you probably come across misunderstandings, misapprehensions. Elliot talked earlier about only 3% of funds being kind of truly multi-jurisdiction across Europe. What are you finding in terms of what works for different investors when setting up real estate and why?
I was interesting. I had a conversation with a potential new client just 2 days ago, and we always ask the question. We have a range of questions to try and find the right regulatory environment for them in Jersey. One of the questions is, are you going to be targeting any EU investors? Does the EU AFMD overlay apply? And he said yes, UK and Swiss investors. And so I said, well, depending on when you're marketing, from next year, UK and Switzerland, that's not EU. So I think that what we don't tend to see in Jersey anymore, and I think Elliot sort of touched upon it earlier, is people wanting to use Jersey as a platform for pan-European marketing, particularly sort of French, German institutions, that sort of thing. As Elliot described, that sort of AFMD UCITS world for now, at the moment. I think where Jersey has always worked historically is UK investors, Middle East, Far East Asian investors, and then a smattering of European investors, and in recent years where the national private placement regimes are reasonably flexible. And what we found in practice is that most of them are. So there's normally a solution out there. I mean, yes, sometimes you might find yourself in a sort of parallel or feeder structuring world of the type that Alex described to make sure that your sort of a wide global investor base is happy and comfortable with where they are. But, our sense is that from a global investor perspective, and, if you take a step back and you look at the US private equity real estate industry, for example, the investor, whether they're, US tax exempt or non-US tax exempt, they're very used to making that decision between, do we use a Cayman structure, do we use a Delaware structure? And I think, we're starting to see that develop in a sort of European, UK context. So, at the moment, and for so long as Jersey, I think, continues, and I see no reason why it wouldn't continue, to adapt quickly these international standards, remain whitelisted globally, it remains of appeal to global investors.
If I can sort of interrupt and add on there, I think the other thing that I see quite regularly is a very willing approach across the Jersey service providers, across the managers, to test whether the proposed structuring is fit for purpose. I mean, from a governance point of view, it is far better to get the right structuring agreed up front, something that actually does what our investors want it to do. And that is not always Jersey. So having seen over numbers of years the structures being retested, reconsidered, re-looked at with tax changes, it's really great to see that robust approach towards what's being done, and also the quality of the service providers and expert advice that is available on the island and via its links, especially in perhaps the city legal structures as well.
I just want to build on that and talk for a minute about substance, right? So substance was brought in response to the OECD, the need to demonstrate that profit is attributed to where it should belong. And substance has caused real challenges for a number of jurisdictions. But Zena, can I start? What's it meant to your clients? Have you seen big change in how real estate structures have to work in Jersey to comply with substance?
I mean, certainly not from the book that we have, because we operate full, robust corporate governance. So we've always had quarterly board meetings, very experienced board directors, proper mind and management being taken in the jurisdiction, proper consideration of documentation. So I think, no, I mean, where probably you have seen a bit of a difference is Middle East and foreign investors that like to perhaps do things a bit differently with written resolution because they had senior representation of boards outside of the island. I think, you know, we've had to see the use of potentially more NEDs being brought in to provide substance on structures. But in terms of the way we operate, I think Jersey has always led the way from a governance perspective in having proper mind and management and corporate governance for not only day-to-day administration but transactional activity. But I think it's a great thing to be able to demonstrate much stronger substance, and it's definitely gone in our favour.
And Alex, build on that in terms of day-to-day admin. Has it changed? Has it been easy for you to kind of keep the additional record keeping?
Yes, so I think because of the level of governance we had in place, it's been sort of some tweaks around the edges.
Yep.
I think what's probably increased is the level of questioning. Obviously, the introduction of this legislation has led to clients sort of questioning and wanting to make sure that things are robust. I think for the clients who've used Jersey historically, they're sat there going, okay, well, look, actually, no, we've done our DD, and no, look, we're happy that it's little changed around the edge, but pretty much it's business as usual because of the standards Jersey holds itself to. I think we touched on earlier how that sort of background and history and the tried and tested manner of substance is what's probably influencing some of these people who haven't used Jersey before, now moving to Jersey.
And Ben, please.
Well, I was going to say, when I look at substance, I think you've got to look at it through two lenses. The one we've been focused on in recent years because of the new legislation is tax and mind and management and control type issues. And I think Alex has described that very well. The other one is the regulatory requirements. And in Jersey, particularly in the sort of public fund realm, on top of the tax requirements for management and control in the island, there's generally been a requirement for at least two experienced directors to be on a fund management board. But some flexibility around delegation in the context of the economic substance requirements. The norm in closed-ended environment in Jersey is for there to be an onshore advisor to your Jersey board. And in open-ended, more rapid dealing environments, there is scope within the new guidance for investment managers to take a measure of discretionary decisions outside of the island to a Jersey board that sets the strategy and monitors what they're doing. So to a certain extent, both across the closed and open-ended book, we do have business as usual. It's interesting to look at what's going on in the EU at the moment and what may happen around AFMD2, because, of course, what you find there are restrictions to a certain extent as regards how an AFIM can delegate. And ESMA's recent letter to the Commission in the context of preparing for an AFMD2 has just called into question the ability for Luxembourg managers and other European managers to be able to delegate functions back to a UK-based advisor, for example, or a UK-based manager, and asking some questions around the renter-manager model, and so I think that people need to look at that. I think Zina's right. People are sort of committing to particular jurisdictions, and decisions around where people want to be based are now being hardened, and AFMD2 is going to create a point of interest in the years to come. And of course, a point I alluded to earlier, with the UK not round the table, that'll largely be a Franco-German decision. Yep. And so I think managers need to bear that in mind, that there may be some change around the sort of regulatory dynamics around substance and delegation in the years to come.
And again, just Ben, responding to substance, has it seen a change in legal docs? Have you had to write things in, or were they already there?
I think that there has already been in terms of fund documentation, I'd say no. In one or two cases, and normally in the sort of open-ended world I've described, where there might be an element or have been an element of discretionary activity going on in the UK, sometimes just having a look at the management agreements, the advisory agreements, just making sure that functions are properly placed in the respective jurisdictions. Actually, very little of that, which has been pleasing, because I think things have been set up properly in the first place. It does require a real focus on good corporate governance, but I think that's always been Jersey's strength. So, when we look at minutes now, we're very focused on that and making sure that strategic decisions are properly and fully captured. Again, that's a that's just a perpetuation of existing good practice, I think. Maybe around areas like finance companies, intragroup loans, that sort of thing. A bit of tightening up there around the way that we describe the terms around loans and a bit more ongoing monitoring. But again, this is just a perpetuation of good practice.
Okay. We've got about 5 minutes to go. I want to just close with a question for you all, please. Around what advice would you give to a manager who's hearing and believes that the only way to structure a fund for UK real estate is, firstly, an onshore UK structure? What advice would you give?
Look at the numbers, look at the guidance. I think, Jersey has got a huge proportion, as Elliot said, of AUM structured here.
Yep.
It's a tried and tested jurisdiction. The UK will work for types of assets, development, for example. But I think, we have a model that works, and it's got to work for the investor. Like I said, it's got to work for the investor, for tax, for governance, for all these issues. Has to work for the manager as well. And, our proximity to the UK is great. We've managed to keep our airports open during COVID. We've got a very good testing system, so we are open for business. And I think, that's a good strength. And obviously, we've got a very, very strong and stable political area where the UK obviously has some difficult times to go in the coming weeks and months. So.
Yeah. Absolutely. So optionality again is key.
Yeah.
And again, same question. Only option is a Luxembourg structure. Is that the right consideration? What else do they need to think about? Alex?
So I think the one thing I'd probably highlight is just the speed to market, and the flexibility of the Jersey regime. There's going to be a solution with our broad range of products, but it's used the Jersey Private Fund as an example. The fact that can be regulated in 48 hours, I think there's that's a real strength of Jersey's regime.
And Belinda, what would you say the biggest strength, and Ben, maybe you could think about this as well, what's the biggest strength of Jersey that you think when you deal with international investors, international managers, biggest strength that's underestimated, underappreciated?
I would say good, it's my background, good corporate governance, compliance, quality of service provision. And those are still underestimated, although they are going, as we've spoken about, they are going much higher up the agenda, everyone's agenda. People are becoming more aware of them, which is great. And then also the benefits that can be gotten from positive impacts of those things. So compliance is moving from being seen as just a cost, just something that's got to be done, same with corporate governance, to the real benefits that can provide. And there are all sorts of themes coming out from that at the moment, diversity, and I'm seeing that across boards, seeing a more inclusion of voices, and it is only good for business. It's good for Jersey, and it's good for the asset class, and it's good for business.
Very good, very good. Okay, so I'm going to attempt to sum up, right? So what we've heard from Elliot around just how our broad industry works and the options Jersey provides. Ben's elaborated on that with structuring, talked about the different structures, talked about distribution under national private placement regime. So we've heard a lot about the options. We've heard about the variety of structures. We've heard of limited partnerships, we've heard of corporate vehicles, and we've heard of the regulatory framework and the benefits that JPF gives in terms of flexibility and speed to market. We've heard about how the industry in Jersey has thrived through COVID. We've survived, we've coped, we've put in place some innovative solutions, and we've done very well in the last 6 months despite what was a big change. But technology has stood up well, working from home, DocuSign, electronic innovation. The Commission, government, regulator, everyone's come together very, very well on that. And what we've also heard from you is that substance, which could have been a big challenge and is a challenge for many other jurisdictions, has been met very well in Jersey. And Belinda, as a non-exec director, you've talked about that. Our two administrators and our lawyer on the panel have all talked about that. So we've heard that substance has been something that we've actually embraced and again shown the quality that is absolutely key to our big institutional investor base that we've got here. I guess all that is left for me to do is to thank our audience for joining today. Thank you very much for giving up your time. Thank you for asking any questions. Feedback on those questions will be provided by the team at Jersey Finance. I'd like to thank my panel for their time today to join us to prepare for this. It's been excellent. Thank you. I've really enjoyed the discussion we've had. And I guess all that's left for me is to close our session and wish you all. Thank you very much.